Hey everyone, I want to give a quick shout out to this episode's sponsor, Copper. Copper is an institutional custodian in crypto and provider of prime services. They're also one of my favorite companies in the space, so thank you very much to Copper for making this episode possible. You're going to be hearing all about them later in the show. Hey everyone, this episode is brought to you by Kinto, the safety first L2, accelerating the transition to an on-chain financial system. You're going to be hearing all about them later in the episode, but for now, on with the program. All right, everyone, welcome back to another Roundup edition of On the Margin. Today, I'm joined as always by my trusty co-hosts, Quinn Thompson, Tyler Neville. Fellas, it's a good week to be alive, wouldn't you say?
Not bad.
How we doing?
Mike,
Parabola has hit.
Yeah.
Can I ask
What's
you,
up, Tyler?
did you get your Christmas PJs? You look like a little boy on Christmas.
Tyler was saying such nice things before we got on. And he was like, I'm going to put you down in 10 minutes. I didn't realize you were sitting on that one. You know what else, just to address the elephant in the room here. So yes, my plant has died in the back here. I'm getting a new plant, but it's like every other comment on YouTube is like, can't keep the plant alive. Plant is dead. We're getting a new one this weekend. So yeah.
Signs of a good founder. Sacrifices
Exactly.
plants for the business.
Yeah. I'm just so focused, man. I'm just so focused. No time for these plants. But what do you guys think? I mean, before we get into any specific stories even, I mean, I think we're at the time of recording here, which is around 10 a.m. on Friday. I mean, Bitcoin is, I guess we technically broke our all-time high, but we're sitting at just under 69,000 again. You know, this is sort of that critical level where it feels like the market really has the actual breakout post all-time high. I mean, what are you guys thinking just looking at everything here?
Yeah, I mean, we're like $20 on Bitcoin from 69. So we're going to blast through all-time highs again. We talked last week about how bullish we were and the ability to start hitting those parabolic moves. I think the ETF flows, despite the down NASDAQ days, right? We had that period of weakness for the NASDAQ, pretty big red days. ETF flows just completely unbothered. We, going into the week, had extreme funding, high leverage open interest and funding rates, which got completely wiped out on that, 10K 69 to 59 wick. I think the stage is set here. I mean, it's really tough to argue as equities, NVIDIA, all the indices continue to roar. Very difficult to see crypto going down from here. It's like such a perfect situation.
These flows are just relentless. I mean, so if you're following along via video here, I mean, it looked like it was going to stop. A couple weeks ago, we were printing, $500 million plus daily net inflows, and this is interesting because the GBTC outflows are actually picking up. Somewhere in the neighborhood of between 200 and 500 per day. But the net inflows into the rest of these 9 products, it's like 500 million, 600 million, 400 million. It's just been pretty nuts. I mean, how sustainable ultimately do you think this guy is? This is this what's going to keep driving the market, or what do you think?
Well, here's my thing with these flows is obviously, when you talk about $1 trillion asset managers, these are kind of smaller numbers when you take into the aggregate, ecosystem of retirement funds, et cetera. One interesting anecdote is, I don't know if this is bullish or bearish, but a lot of my extended family members reached out because I'm the crypto guy, and they're all at, say, Northwestern Mutual or Vanguard or all these other companies. And if you see Larry Fink and Franklin Templeton and Bitwise and Fidelity, they are taking monster fees off these inflows. And there's a whole section of the market, like Northwestern Mutual, you can't buy Bitcoin there. They're huge. You can't buy Bitcoin at a lot of these RIAs. And the longer the performance drag, and you see Larry Fink's putting it in a couple of his funds, outside of just Bitcoin ETF. So this creates
Morgan Stanley.
Yeah, the performance drag and like the access is going to change for a lot of other people, and the first mover advantage. And then, to boot, you see like Bukele's having, the head of Qatar come. Like now it's a sovereign issue, right? And so can these flows keep up? I'm kind of like opposite of Jim Bianco here, where this might be like this psychological shift in asset class.
Well, that whole theory that it's bad because faster money's coming in has been disproven when we had 2 multiple % down days on NASDAQ and the flows were positive. So you can put that to bed because those would have been the days to see outflows, and it just didn't happen.
I think it is possible as well that this could be faster. I mean, we've sort of heard that the wirehouses aren't really set up here. I don't really think this is like slow RIA money coming in. One thing that I've been thinking about is that if this is sort of faster, more hedge fund type money where that these flows are coming from, you could see a situation where like probably everything gets set up for the RIAs to like really start plowing in like 6 months or something like that, which maybe just means they're getting in at sort of a worse price. I don't know, but it feels like we're just starting to pick up momentum here, and it's way too early to start saying, oh, this has to turn around soon. Oh, there's going to be a bunch of sales. Like, I just don't think this is the time for that yet, to be honest.
I agree. And I think yeah, go ahead.
No. What do you think, Quinn?
I was going to say it's a little changing the topic to non-Bitcoin stuff, but I think my opinion is we're close to peak Bitcoin. Bitcoin's going to lead the cycle type of mentality. I think obviously Sol's ripped, but most alts have lagged. A lot of people were looking for that leverage flush to get long alt again, which it happened. And I think the next logical thing for the BlackRocks and Fidelities of the world is obviously the ETH ETF, but what else? And I just think we're set here as Bitcoin crosses all-time highs to get into what else out there in crypto.
Hey everyone, wanted to give a quick shout out to this episode's sponsor, Copper. Copper is an institutional custodian and provider of prime services within digital assets. Today, what I want to talk to you specifically about is Clearloop. Clearloop is a solution from Copper, which to me solves one of the biggest problems for market makers, high frequency traders, hedge funds within digital assets. You know the exquisite pain of what I call the pre-funding problem. So if you want to take advantage of arbitrages that pop up across different exchanges, or you just have a trading strategy which requires you to be active on multiple different centralized exchanges, you have to pre-fund your account at each one of those exchanges. Now, this is not ideal for a whole bunch of reasons. One, you have to take counterparty risk from those exchanges, which, as we saw this last year, can have major consequences. Two, it's capital inefficient. You have a whole bunch of assets spread out. Most of them are not doing anything most of the time. And three, it's just not great from a workflow standpoint, and it creates administrative overhead. So enter Clearloop. Clearloop is the secure MPC custody solution provided by Copper. The way that it works is you deposit your assets into this MPC solution, which is owned and operated by you. Clearloop syncs up with a whole bunch of your favorite exchanges, and then you can trade securely from Clearloop itself while not taking any counterparty exchange risk with any of these exchanges. And it's a super easy and nice UX. Now, Clearloop is trusted by the likes of Flow Traders, Brevin Howard, Nickel, some of the best in the business. But the coup de grace is in the extreme edge case that one of these exchanges were to go bankrupt, they have a very clever trust structure which segregates your assets and keeps you completely protected. So click the link at the bottom of this episode, especially if you're a hedge fund and market maker and you want to learn more, or better yet, Dimitri, the CEO, is actually going to be in person on a panel hosted by yours truly at Digital Asset Summit. So DAS London, that's March 18th to the 20th in London. So you should definitely click the link at the bottom of this episode, give your boy some credit, but also, even better, come to DAS London and hear from Dimitri himself. All right, cheers everyone. Hey everyone, this episode is brought to you by Kinto, the safety first layer 2 that is accelerating the transition to the on-chain financial system. Now, I know we're all very excited about tokenization. Larry Fink certainly is. He's on CNBC talking about it all the time. And I know we're all very excited about L2s. Here's the problem though. If we want L2s to onboard the financial system, there's a lot of stuff that we still need. And Kinto is basically rolling out solutions for that. So one, it features user-owned KYC, which is just table stakes for our regulated friends. And if we want the institutional capital to come in, Kinto offers a really good solution for that. They also have native account abstraction that solves some of the largest problems with onboarding in terms of security and user experience today, which is still very confusing. So if we want to bring more folks onto Ethereum, Kinto is the way to do that. And if you believe in this on-chain financial system and you actually want to get more active in Kinto and become a founding member, you should join their launch program, which is Engine. That's ENGN. You can see a link in the show notes. So if you're a part of that, you can do things like participate in Kinto governance, the launch ceremony, you can priority access to product launches on Kinto, you get reduced fees and unique discounts on products launched on Kinto. So overall, if you want to be a part of Kinto and the mission that they have, I would go click the link, join the Engine program, and thank me later. That's also, for what it's worth, we've got this London conference coming up, and but like Franklin Templeton speaking, BlackRock is speaking, all these guys are going to be there. And I don't want to front run the content too much, but I can tell you they're definitely excited about Bitcoin, but they want to talk about what they've got coming up after the Bitcoin ETFs. Like, this is just the first step, the first rung on the ladder for them, I think. So
can we talk about, I think we briefly touched on this before we started recording, but one big thing that I have wrapping around my brain is, in a world, what is debt? Like, what is debt? Because a 60-40 portfolio, how many millennials and Gen Zers are putting their money there when you've basically, federalized, or I don't know the term, the debt market? Like 2008, you bailed out the creditors. You keep continuously kind of bailing them out on every little credit crisis, Silicon Valley Bank. It's like kicking the can on the debt markets. What incentive does the next generation have to own bonds? And that's like a scary thought. Why would we buy a 60-40 portfolio? Besides the fact that, your automatic traditional 401k automatically invests in those funds. Like, that's the only mechanism of why your money is going to there still. But it really doesn't make sense in a world where fiscal policy is now driving everything. I don't get it.
Yeah, the history too of 60-40 is more recent. It's not 100, 200 years old, right? Like, interest rates weren't always down only. And so all of the investing world's experience today lives in a down interest rate environment, low inflation. And, if you get a period of 10 or 20 years where that's not the case, the 60-40 should be thrown out the window. So I think most of the big macro, and a lot of people have been on this for is bonds have underperformed every year. I just saw, today's relatively soft jobs number and Powell's testimony that, they're still very close to cutting, is just like, oh my God, how could you possibly buy long duration bonds? I mean, just setting up, oil's firm, inflation expectations are at highs. The economies are inflecting up. China's putting up better numbers. The US it's just like, you're going to get ran over by the yield's got to be going to 5 to 6% at some point in the next 12 months.
I don't even know if that matters. I actually take the contra in China. I think they're kind of slowing, but in flat, oil's even going lower today in all this. But the point is in a long-term perspective, you have assets that are going up 40%, 50%. Stocks are ripping. And why would you own a bond in that? The relative loss you take of wealth by owning a bond is astronomical. So I guess that's more my existential, when you're a millennial or a Gen Zer, why would you own that stuff? Unless they were really fiscally conservative and not having a $2 trillion deficit. So that's where I differ with Bianco is I don't understand why that still matters to him.
So I think there's, to maybe take the other side of it, I'm in agreement with you guys, but just to take the other side of this, because we had a conversation that's going to be airing on this podcast next week with Jim Bianco and Eric Balkunas, where we talked about this. The flip side of this is one, I think there's an age component here, right? Which is basically the younger you are, the more risk you should eat. But if you're retired and you don't really have the ability to go out there and win 20 more years of income, you just got to be naturally more risk averse. And that's why those sorts of people very rationally prefer fixed coupons, stuff like that, right? So there is an age component here as well that I think. I think the other thing is a very rational point that you could make is in terms of capital structure, bonds sit senior, right? So there was actually a really interesting discussion I would encourage everyone to go listen to with Dimitri Kofinas. And I think it was Andy Constant and Mike Green where it's basically exactly what we're describing here, Dimitri's of the perspective. I actually would rather buy a stock than a bond. And I think it was Andy that made the point, there are bonds in those stocks, right? These aren't like totally independent things, right? So basically if bonds go low enough, it's going to suck a whole bunch of capital into them because yields will just get attractive enough that you kind of just have to do it, I think. But to maybe agree with you and Tyler, to your point that sometimes markets are more of a social and political tool than they are really about economics, is I think that at the highest level, the incentives here are that there's been a big bubble in the sovereign bond market for a while, and ultimately we need to find a way to fix that. Mm-hmm. And the incentives here for policymakers, outside of just making sure that the wheels stay on, is to rewrite things. And I think the way that you have to do that is some form of fiscal repression, right, or financial repression. And so I think the incentive is actually to punish bondholders for the next 20 years until we right size this little bubble.
And it makes sense because like boomers want fixed income now. They're going to kind of keep the rates moderate for them because they're risk averse, right? And we'll go out on the risk spectrum and make up, probably inflate the crap out of all the debt. And so they'll be on that fixed income and, we'll corner the float on equities.
Yeah.
Well, I think that's the point here is the difference in having in real rates versus nominal is like we're talking about stocks and Bitcoin and crypto and real estate and assets priced nominally. And in a world where yields are artificially held down and real rates are artificially depressed, it's just like these release valve assets where the capital has to flow and you can't be just eating it on the chin in bonds.
Yeah. The release valve asset. That's a great quote. I feel like Bitcoin is a release valve asset.
It is a release valve asset. And there's a social component to all of this as well, which is maybe why there's a little bit of a generational divide here. I think the whole purpose why US capital markets work so well is it's supposed to be this neutral, fair system. And I think there have been a couple very salient reminders in the last decade or so that that's not actually how it works all the time. And so as soon as people start to feel like the game is rigged, or hey, maybe this isn't just 100% neutral, even playing field here for everyone involved, then people start looking for alternatives. And like weird social stuff starts to happen, populism, all that kind of thing. So you know what I mean? I think there's an element of missing the forest for the trees, or whatever the expression is. Okay, so our policymakers are much, much better. They understand the software of the monetary system much better than they ever did. But you've nominally kept things together, but you've got a whole bunch of people that are pretty unhappy, despite having, again, nominally kept things together. And I think,
well, even you look at this latest, the NYCB or whatever, their rescue. It's like by Mnuchin and another old ex-government official. It's like even that's an orchestrated government bailout. If you just read through what that read between the lines. So I think we could maybe on this macro stuff, like it goes to the other point we had written down, which is just like stocks not going down in an election year being kind of like meme or a narrative, but like also based in a lot of rationale.
So let's just give a little bit of detail. So this is NYCB is New York City Bank Corp. And they had a big portfolio of commercial real estate. People have been talking for, seems like the last 18 months about how troubled that particular asset class is. But everything really, went over into a boiling point. Stock dipped like 45% until, Mnuchin's fund and the ex-comptroller of the currency injected $1 billion basically overnight. So this is Liberty Strategic Capital. They led this group of investors. The terms of the deal aren't public. I would have to imagine this is like the most sweetheart deal of all time for these guys. Because that's
actually think they know something. You think they know something? I wonder.
But to your point, actually, to this whole point about distrust, I mean, this is what's supposed to happen, right? Like if you talk to people in banking, they would say, this is a great example of how like the government didn't need to step in. This is kind of the system working as it's supposed to work. I think there's a really strong counterpoint here to how this is a net negative for society, but it's just funny that we're all being like, oh, is it rigged? Is there something behind this? Where this is actually, it's kind of it's been working like this for 50 years, basically. Like this is almost always what happens. But I mean, do you guys also think that this means there's more trouble? Because whenever one of these sort of small regional bank fails, you get two choruses of people. You got the banking system's in trouble, like those sorts of people. And then you got hey, this is kind of creative destruction. Maybe we don't need this many small community banks, and these things should just get absorbed into these big JP Morgans of the world. What do you guys think about this?
My personal take is the more they centralize the traditional banking system, the more Bitcoin's going to go up. And it's clear the narrative is out there. People understand what's going on. There's a release valve now, and they know it. And people talk about it. If you go out to dinner with your friends now, they're probably aware that, why would I invest in JP Morgan? It's really, what's your upside there? It's a mega bank. You need to lend to mega institutions. And how much bigger and centralized can that system get? So I know I always bring up Mr. Beast, but it really is the same thing as mainstream media, kind of like death by 1,000 cuts for somebody who's up and coming and new. I'd rather bet on the up and comer almost every time instead of this old bureaucratic institution.
Yeah, the markets have moved way beyond is there more shoes to fall? Is this bad for the the government showed their hand 50 times now that they bail it out quicker and quicker. So tech, Bitcoin, everything rallies when you see these headlines because they're going to bail them out. And I think it's funny to me when you zoom out that we're having these conversations of is the market, is there something going on with the market? Is the government supporting and a lot of that generational divide is everyone looking at crypto and meme coins and meme stocks and, oh, it's the monkeys trading it. How could they, we're so overheated. But in reality, it's no, Yellen, the Fed, they're telling you to do this implicitly. We're going to keep rates low. We're going to nationalize the debt. There's this, can't remember the podcast, this Whitney woman, she was on, she was making the podcast rounds and just talks about how really the last two big, yeah. Awesome podcast. I can't remember which one that was I listened to, but in 23, we just basically nationalized it by issuing no duration, just all bills. And in 21, obviously was just growing the balance sheet. So everybody's telling you to just be very long risk assets. And so it's no surprise that everyone's become a risk asset trader.
By the way, happy all-time high, guys. We're now at 69,500, something like that. So I think we can officially call it here. Yeah, this was...
Well, it hit 70K.
All right, yeah. 70 is pretty definitive. So happy all-time high day to those who celebrate.
While we're talking about Bitcoin and the bring it off the macro back to the crypto, we got to talk about our little bet. Now that
the bet,
Mike, me and you are in the it's time to go everything but Bitcoin camp, and we got Tyler holding firm in the Bitcoin.
Yeah, let's talk about this.
All right, let's do it.
It was sparked because Citron Research, who are pretty smart guys in my opinion, I like those guys. And I always think short sellers are actually the most brilliant guys there, but they're just fighting this rising institutional tide. But they said, long Bitcoin. What was it? Long Coinbase short?
Yeah. They were long Bitcoin, short coin.
Yeah,
Coinbase stock.
And I thought, that's not a completely idiotic trade. And, Quinn took the opposite side of that trade. And this is not investment advice. This is just for fun. But anyway, so we made a bet that, Coinbase would underperform Bitcoin.
We gotta align on timelines here. I know we said whenever. What do we decide on here so the listeners can get a final update?
We both said over any time. We were both so confident in our positions that we said any timeline. But then we agreed on June because that's when a lot of coin call options that I have on the books expire.
Yeah. All right. After the halvening, you're screwed.
Not financial advice. Not financial advice. Okay.
My reasoning is this, because you can always issue equity. If your stock goes up enough, you're going to issue equity, right? You can't issue more Bitcoin, especially after the halvening, so that the convexity of the asset is way better than owning equity.
Okay, here is my exact rationale for this because, and you know what the irony, Tyler, is that the interview that you did with Russell Clark way back in the day, that guy, I heard him say this on this podcast and it completely changed my mind about how I think about it. He was like, look, just to paraphrase Russell, I've seen a lot of people say, there's this fixed supply thing and it never really works out like that because people seek alternatives. And honestly, I sat on that. I listened to it. No. This is different. And then I kind of listened and I was like, damn, that's actually really what happens in crypto. It's like the price of Bitcoin goes high enough and then people just spread out into other things. I've just seen it so many times, and every single time there's a new narrative for why it's not going to happen. And by the way, I know a lot of people listening to the show love Bitcoin. I also love Bitcoin. It's still my biggest holding. I'm a massive fan of it. I think it's a thing to hold for the long term, but it's just, if you want to do anything, active in these cycles, like I just find it really hard to argue that Bitcoin's going to do better than these other things. It's probably the best risk adjusted thing you could do.
Let me play a devil's advocate to that, because there's one difference in this cycle than the last cycle. And I'm not like a altcoin hater by any means. On some I am, but like I get some of this stuff. My big difference is access. Like we have our whole investment philosophy is based off, it's not, PE ratios and growth ratios. It's very simple. Like, how do you value a piece of art or any other asset like Bitcoin? Access, awareness, custody, patina, and use as collateral. Those are like very basic principles. But the point is, custody is a huge thing for institutional investment. You're not going to have custody for all these crazy altcoins like you do Bitcoin now. So the potential for like memeability or GameStop scenario in Bitcoin is way higher this cycle, because you have giant pools of capital on a super highway into this one thing, right? You don't have that into, it will seek the other ones. Perhaps the other ones outperform Bitcoin. But I think like the potential when you have like sovereign wealth funds buying this stuff, and custody is easy because, the liquidity of Bitcoin and options market hedge out, you have these institutionalized super highways now, right? And so that point is what's missing in all this. Is like, if you have the super highways built for the altcoins, I agree with you. You can create more and they seek those new stores of value, but it's on just this one asset right now.
So that's it sounds good, but it's wrong, because in the last cycle, so when you think about GBTC and ETH last cycle as these like TradFi trusts to get Bitcoin access, and maybe just as a proxy.
Yeah.
There was 6.5 billion, I think it was, inflows to GBTC and like 1.5 into ETH. And that's like, 5 to 6 times greater into Bitcoin. Keep in mind, this was when the Bitcoin market cap was not $1 trillion. So these flows were of somewhat similar magnitude to the ETF flows of today.
Mm-hmm.
And in order of magnitude more to Bitcoin than ETH, but ETH outperformed 2 to 3x. Why? Obviously, smaller market cap takes less flows to move the needle. But out of those like 9 billion of flows into these TradFi vehicles, there's 125 billion in stablecoin inflows. And so year to date, where we have like 10ish or whatever net Bitcoin ETF flows, it's basically double that into stablecoins. We're at like 14 or 15 billion in stablecoins. So, and then it's noted via like all the exchange data, trading data, like Coinbase, etc. Bitcoin only makes up like 30% of the trading volumes of crypto native exchanges. So basically, whatever every dollar into Bitcoin ETF, there's an order of magnitude more going into stablecoins and other assets, and those are all smaller assets that take a lot.
That's a good argument. That's a good argument. I can take that. But what's the TAM of all the trillions of dollars that's potentially open to Bitcoin now?
I don't think trillions are coming in. I got to be honest with you. Not right. Not like
the TAM of like the potential trillions. I mean, you have trillions. Look at BlackRock, Franklin. They're all $1 trillion asset managers. That's my point. Is like you move a percentage of that, and it's big relative to the float.
I guess I will believe that when I see it, because I've just been hearing it for so long. And I know at some point it's going to happen, and I know, but like, I think I will believe that when I really see it. But I think even when that actually does start to happen, Quinn's point is really the thing that people miss, which is the bigger it gets, the more liquid it is, the more dollars coming in doesn't actually move the price. And by the way, unless this is sounding non-constructive on Bitcoin, that's what we should all be hoping for. If you're hoping for the success of Bitcoin, you're hoping for something that doesn't have this crazy volatility, because if we're ever going to use this thing like money, it can't keep behaving like this price wise, right? Like, this is Bitcoin winning, at least in my opinion. So, there's an interesting argument to be had about whether or not these ETFs are going to lead to, are they going to be vol dampening on a short time frame, on a long time frame? It's fun to discuss, but like in my mind, the success case for Bitcoin is lower volatility, real money-like adoption. That's at least the way that I think about it.
Yeah, I think we got to get Tyler, like, just block 24 hours, get him like of just meme coin, get him in the trenches, and he'll start to understand, like kind of like the one I had this weekend, where you'll start to understand. Then you're like, it makes the case why you want to own the casino.
I did it last cycle.
Who benefits?
I did it last cycle, and I was like, this is so ridiculous. Like, and I made good money on it, but like I also like, I like existentially putting my money in a place where like it's like the story of you become a bazillionaire, but you have no idea why, and then your whole life you're depressed because it didn't follow like who you are as a person. Do you believe
I think that's a really good point.
Yeah.
I think that's a really good point, but that's really like just lest, to dispel some of this, because this is the way that it gets sort of fragmented, is, oh, Bitcoin is legitimate and everything else is kind of this shitcoin thing that might go up more. It's just like really not how I view it. That I really view all of this stuff as tech. Ultimately, we can say it's money, it's a commodity. There's tech that supports all of this. These are all computer networks, and these things are real. There's real innovation here. Don't let people tell you it's not legitimate. That's just not reality. People can tell you, and they should tell you, that they're startups and that they can fail. Most of them will, 100%. But don't let people tell you that they're not legitimate. That makes no sense.
We're gonna get Tyler back in 25 years, he's gonna be telling his grandkids he's a multi-billionaire off Zincoin.
Wait, can we actually talk about something that happened this week, which was, we were talking about this a little bit, but there's a pretty large estate sale from FTX on Solana. And I think this was acting as a little bit of an overhang in the price of Solana. And at least I was pretty curious this week about what Solana was going to do. And it looks like it is just chugging right along. So I don't know, Quinn, if you give us a little bit more color on this sale and what that ultimately means.
Yeah, it's out there all publicly in the filings and things with the FTX estate in the courts. And it's so Galaxy, we know Galaxy has been managing a lot of the liquidations in that process. And the biggest piece of all, in the fall, they sold a lot of liquid stuff, primarily SOL, and the biggest piece was this locked SOL position, which was becoming quite large with the SOL price moves. I think closer to $6 billion in notional value. And we know that, John Ray and the estate's trying to get this case wrapped as soon as possible and get the funding back. So, that process has been ongoing. There's been a lot of talk on Twitter. I'm not for sure where it ended or settled, but I think, you have two camps in the situation, right? Where it's a huge amount of supply that needs to be absorbed. And that, some people might want to hedge it. Some people might need to offload existing SOL exposure to make room. And then you see price action like this, the week or so after it's been done. And I think it's pretty telling. You have to listen to the market here. I mean, you probably had every fund and their brother looking at this deal, doing the diligence, digging in, and probably tells me that SOL's still relatively underowned relative to other alts in the ecosystem. And you probably had funds digging in and thinking, well, we might need more exposure now that than what we can buy here. And the price is kind of saying that. Plus, you removed this massive SBF FTX overhang. It's kind of like, Tyler, you made the analogy to when there's a big, maybe post-bankruptcy lender turned owner in a stock that has an overhang or things like that, and they finally get out and the price rips because you remove this massive risk. So yeah, it's pretty telling. I think the market moves near the end of this week.
You know what else is just kind of interesting about these is like it's naturally decentralizing, where I think the first time Solana pumped, it was SBF kind of choking the float, and a lot of the float of Solana was just like really tight. And now this cycle, you know, that actually worked against you with your, Grayscale, and Grayscale basically cornered a lot of the assets, and then now it's naturally decentralizing, as these bigger institutions kind of take on, and maybe that same sort of process is happening in Solana now.
Yeah, I just think there's quite a bit of demand for this stuff, and from my listenings, I mean, I think there's been it's kind of, there's what actually ends up happening in markets, and then there's the expectations and how everyone's positioned. And I think this is one of those things where the market just kind of got a tell here that there was an enormous amount of demand for this SOL that was coming online, and then it's less of an issue, right? Whereas if everyone sort of thought, oh, maybe there's going to be much less demand. So yeah, I also think this is just what Quinn and I were sort of talking about, that I think Bitcoin's going to lead here for a little while, but I think some of these other alts are ultimately going to run. But I will say that supply is the one thing that people stop. Like, this is around the time when people stop caring about supply, but supply dynamics, especially when it comes to crypto, are probably the single most important thing that you should be aware of if you're buying some of this stuff. And, the way that most money gets raised in these like altcoin sort of projects is people raise, there's like a 2-year lock with a 1-year cliff. A lot of money starts getting raised right around now. People start doing these mental calculations of, man, I'm going to have liquidity in about a year. If all this stuff is going up 10x, I can sell half my bag or whatever. And that's why, like, you just look at so many charts. It's this like crazy wick up, and then just like it just cascades down. So I just, lest anyone here, that's like part of one of these like structurally cyclical dynamics that are just embedded in this industry that I just do not think is going away anytime soon.
I think this is where, Tyler, you have a huge point, and I think we all, there's some component of everybody in crypto that agrees with you on if you're in the like Bitcoin camp, which is I'm of the belief there's very few assets you can be a long-term owner of yet, like Bitcoin, probably ETH, and now probably SOL is in the big three, but everything else, you have to remember what it is. Like in these bull markets, it's like, world-changing technology narratives, but they are just really early liquid venture protocols and projects, and there's extreme volatility and a lot that can happen. So it is pretty interesting. It's similar to the funding rate, excess, where when demand gets so high, eventually, the ducks are quacking, people will feed them, and there'll be endless supply of tokens coming to market that ultimately satiates that demand and leads to the corrections. So I think that's a good point, Mike. When you're in these, very significant uptrends, you got to be dancing, and you have to, but you can't lose sight of the big picture that you probably don't want to be long-term bag holders turned community members.
Here's, yeah, in it for the tech. Here's an interesting dynamic as well. There was a massive bubble around 2021 of, most of the institutional activity that was involved in that time was the US. And US institutions, if they weren't buying mostly Bitcoin, they were like, I want exposure here in a venture capital wrapper, right? That's the wrapper that I feel like this makes sense with and goes along. And so there was this enormous bubble in valuations of some of those like last cycle companies, like data companies, custodians, et cetera. And this was sort of this was like peak Tiger mania as well, where there were all of these rounds. I remember, there would be rounds where some company was raising $500 million off of, $4 million in revenue, so do that multiple math in your head. And then Tiger would say, I will double the valuation, but we got to take down the whole round. So people were getting truly ludicrous valuations because there was this, again, kind of this supply demand mismatch where a lot of institutional money wanted exposure. There weren't a ton of great private opportunities, but people would rather put their money in that than the liquids. And that pain still hasn't been fully worked through yet. And if you talk to a lot of funds, like some of them had, like a lot of funds today will have privates and liquids, but like it's like a tale of two cities, between the returns from the liquid side of things versus pure private. Obviously, there are exceptions to this, and there are great success stories, et cetera. But I think that imbalance still hasn't been fully worked out of the market yet. So that's just another dynamic to be aware of.
Yeah, makes the incentive to play the tokens way better. I mean, especially in like at that time, you had negative real rates, and like it was a post-truth world. Like, what was the valuation of anything? Could be $1 bazillion, right? But I mean, the problem is, as an entrepreneur, is like you never want to overvalue yourself like that, because then
it's greedy.
Going to get crazy.
Here, you know what? Something I was thinking about is, okay, there's this small class of assets, Bitcoin, ETH. I would put Solana in this bag, that are trying to be these like commodity money-like assets, right? Some of them will be, a lot of them won't be, but that's what they're trying to be. That's like I think a truly new asset class. A lot of these other tokens are just equities, but they get liquid at a super early stage. And like, I want to be careful, let less folks here. Like, I listened to a whole podcast and someone like doing deep analysis on meme coins, and it's like, okay, this is around the time of the cycle where people like actually are doing like real relative analysis on like dog coins versus cat coins. Like, that's just silly. You should just like disregard all of that. But I think there is actually an argument to be made that there's a liquidity premium on these tokens. Like, all else equal, right? You'd rather have something that's liquid as opposed to illiquid. That's the thing about startup equity that's really tough, right? It's like you're illiquid for a really long period of time, average is like 7 years or something like that. And it's only getting longer. People are only staying private longer. So I was sort of thinking about this the other day because I was trying to model out how like the way like protocols fund themselves versus startups fund themselves is super different. And I was just sort of thinking to myself, actually, there should be some sort of premium on these instruments being publicly traded, right? Like, wouldn't you guys rather own something that you could buy or sell immediately as opposed to being locked up for some indeterminate period of time based on when the founders want to sell?
Yeah, that's great.
It kind of makes sense. Like, yeah. It should be higher, I think.
I think that we're in a environment where it's now a premium, but when you're in a horrific bear market, it's a discount because everyone needs the liquidity. So I think that's just like a ebb and flow of the cyclicality of it. But to your point, I mean, it is a pretty novel mechanism for early stage founders. I would say the thing that you see quite a lot is though the adverse incentives where like some of these like new L1s and projects that come to market with like a $4 billion token and no product. And then it's like, all right, thanks. And there's like no incentive for people to keep working on it. So I think you see both sides, but obviously there's some like, it's just, that's more of like the people side of it. You have to know what teams you're backing and things and try and get a sense of who's going to be committed. Like Tolly and Solana, like people like that, Vitalik, right? Like there's a lot of the real, go-getters in the space.
This kind of goes back to my whole like short volatility, long volatility thesis. A lot has to do with like liquidity. It goes hand in hand. But if you look at like the traditional TradFi world, almost all information is like known right at that minute. In fact, the algos are so good at discounting like any news. Like that's part of why there's this information asymmetry can only happen in places where people actually understand something that someone else doesn't. And therein lies alpha, right? And that whole process, it's why private markets, there can be actually a massive bid-ask spread between, like Forge or shares post. I think they merged or something, but like there's information asymmetry. There's like a future that someone believes and someone else, disagrees with. And that just doesn't really exist in public markets anymore. So you're dealing with returns that are smaller and smaller, right? And everything's so liquid, it's become a public proxy. Like it's become like a public utility for pensions and all these other things, because that's how they tweak the game, because that's basically what finances the government at the end of the day. But my end point is that, yes, I agree with you that, this illiquidity premium is really where you find great returns, and your risk reward, it's probably the best spot of risk reward when interest rates are low and volatility is low in both, the credit markets and equity markets. Is that a little bit too? That's my
That
call.
makes sense. Yeah, that makes sense. It makes a ton of sense. And I don't know. I also, I just want to again state for the listeners that like if you're getting involved in these things, it's super risky. By no means are like you should put a ton of money into this or anything like that. It's just trying to describe the dynamics that you see around these things in some concrete terms. I want to talk to you guys a little bit about. We had a big political week. So we had Super Tuesday, and obviously this isn't a politics podcast. I don't really want to get into the specifics of US politics, which are sort of fraught right now, but the TLDR, and maybe one of you guys like went a little bit deeper on this than I did, is it was a landslide for Trump, I think. And so basically what we walked away from Super Tuesday with is understanding that this is going to be a Trump versus Biden election. We also had a State of the Union last night, which went, from my understanding, I guess, okay. I don't know. But it's going to be Trump versus Biden, regardless about how you feel about that. I think there are implications for markets because people remember what happened last time Trump was president. We know that he likes tax cuts. He is a billionaire. And I think specifically when it comes to crypto, people are, this administration under Biden has been extremely unfavorable from a regulatory standpoint. And, we can talk, Quinn, a little bit about that article that you dropped about Elizabeth Warren walking back some of her rhetoric around crypto. She's no longer building an anti-crypto army. So there is a sense that maybe tides could be shifting in terms of politics here in the US. And regardless of how you feel about that personally, there's a markets implication there as well. So what's your guys' read on all this?
Yeah. I mean, even before we get to November, like it's so clear that the tides are turning, right? We had the Ripple case, the Grayscale case, the ETF. We have the Coinbase case where the hearings have been very favorable to the industry. And then you get these things like the SEC's crypto lead who led these cases leaving to go private practice to defend these companies. And it's like, and there's been just numerous of these, we never known how much to read into like mid-level or upper level staff leaving, because there could be many reasons they're leaving, but it's very clear like the SEC has their back against the wall. They're getting hit pretty hard in traditional markets as well. Like Ken Griffin and people also have a lot of beef with them. So I think it's just a sign of the times. And you have an ETF that opens up, tens of thousands of new holders into this asset class. And whether you're Democrat or Republican, you can't be against something that your constituents like are, really advocating for. So that's why you're seeing Warren backing down. There's this week that thing out of Arizona where the Senate's considering putting Bitcoin into the state retirement plan. I mean, it's just so reminiscent of the headlines of last cycle, right? Where Tesla buys and all these corporates are buying, and then these sovereigns want to get it. It's just like, it's only a matter of time, Tyler, like you said, before we get the Qatar and this, like some big sovereign buy. It's so, there's so much FOMO that comes and then it's rational too, because you're underperforming if you don't own it. So the political implications are huge, even going into November. But particularly, I think, if Trump were to win, all these people would be removed day one. And, think about if the ETH ETF was approved tomorrow, if there was a Sol ETF approved tomorrow. I mean, these things are just massive, and it's tough to price in fully until the events happen.
Yeah, I'm with you. One thing where, who knows who he picks for running mate, but if it's Vivek, who is basically anti-CBDC, that's a sign. Trump's paying attention to the next generation at this point, and that to me is very pro Bitcoin. It's probably already discounted, honestly, in a lot of the market action. I do give Biden credit, for the market is at all-time highs here in inflation. He threaded the needle, but the funny part is he doesn't even take much credit for it. Like he doesn't even pump his own tires. And if Trump did this, it would be like the greatest success ever.
So daily tweets every time the Dow crossed another like $500.
Yeah. And talk about, he should be changing the Overton window to that, Biden should, rather than this other stuff. Anyway, I agree with you on Trump being like a pro crypto thing. And yeah, that's That's all I got really.
It is like it's definitely already discounted in the markets to some extent. I think there's that basket, Tyler, you were mentioning. I can't remember who put that out.
Goldman has a pro-Trump basket.
Yeah,
already like massive.
Which is like Harley Davidson and yeah, like so it's a Geo Group, like immigration stuff. I think it is definitely being priced in more and more. But I actually don't think it's personally priced in enough. I think that it's just one of those things where the range of outcomes is so wide. It's really hard to pin down. When's the first general debate?
That's a good question.
I don't actually think I thought that Biden wasn't going to debate Trump. I thought he came out and said that. If I were him, I would be.
Well, I think you'll have to. I think it'd probably be like the only presidential thing in history without it. There's going to be debates. There has to be.
There is a great comment yesterday where I got to give it. Like Biden looked like he was half a corpse like a couple of weeks ago, but there's a great tweet. It was like, if one thing, this State of the Union is great for modern medicine, to see somebody come out and he did a great job. I thought, like being completely nonpartisan here, like relative to what he's done in the past, where you couldn't even understand him, and he was like sundowning, and they actually jacked him up on whatever amphetamines they had him on. It was pretty impressive.
What do they give like pro athletes after they've like sprained an ankle? It's like, get back in there, Sonny.
Give me that cocktail.
Yeah,
I think what was interesting about this week as well too was on the Super Tuesday front, like how big of a non-event it is. Like in past elections, it's like such a huge thing, and it's just so clear. I think it's like, I mean, people are obviously not that pleased with the fact that these are our two candidates, but it's interesting how non-event Super Tuesday was, just because it's like so consensus already who's going to run.
All right, I want to get your thoughts on actually some of the some more traditional macro stuff here. And I know one of the stories that we had, Tyler, you mentioned this, but there's an interesting quote, and here's I can actually share my screen and walk through this Bloomberg article that the CIO of Goldman Sachs wealth management business called China uninvestable. And you guys were starting to have this debate a little bit at the top of the show about what's going on in China. Are we seeing China pick back up? Is there material weakness in the economy, et cetera? It's an interesting debate. Oh, wait, no, this is the wrong. I'll get the right article here. But yeah, I mean, basically just wanted to get your guys' thought, like expand a little bit more on China and what's going on over there. I know, Tyler, you guys have deep thoughts on this. And then we also had a jobs report come out that I want to get your guys' take on as well.
I guess I'll kick it off, but this is a divisive topic, obviously, but for a generation, or not a generation, but the last 20 years, I'd say we were opening up investment through our retirees into China, and that helped them fuel their military and a lot of their economic might, which is fine. But like when your enemy is fueling their military with U.S. retiree money, I think that's a sign that hey, wake up, America! Like, why don't we have more U.S. based incentives? And I think whatever happened behind closed doors, whether it was like Larry Fink, saying, hey, I need a new frontier to open to invest in rather than give our money to our enemies. But it's obviously way more convoluted than that, since, we do a lot of trade with China, but this is more, from a military perspective. So I think, think about all the money that went in for 20 years from investment around the world. And if they're shutting that down and the capital account is fleeing China, where does that go? Your obvious conclusion is, the U.S. market, which I think we're seeing, we're rebuilding the allied capital market system and not incentivizing like autocrat governments anymore. So that's sort of my take on it. But that's Goldman Sachs saying that is pretty important. They have offices over there. So like there's something that tectonically changed where China's going to have to convince a whole lot of other countries to invest there and give them massive incentives, because I think the U.S. funnel is now toast.
What's the general take, Tyler, on how Biden has been, like, his thought, like, positions towards China versus Trump? Because that's something, like, to be honest, I politically don't follow a ton unless it really affects me or markets. Obviously, there's tons of noise when Trump tariffs and everything, but that's one thing I haven't thought through a lot, is like any implications there from November. But I kind of think Biden's largely kept tariffs and fairly similar position.
He's been even more hawkish than Trump. It's the most like bipartisan thing in the US, is kind of picking apart China. And, capital flows have basically fleed, which is causing this real estate crisis, because they need dollars. And the only dollars they're getting are really from the trade balance now, which is keeping them afloat. And so that's, I don't know, if that breaks apart, then you're probably looking at a more kinetic war. But for now, it's just, capital markets related.
How much do you think, Tyler, this recommendation from Goldman Sachs CIO is just them just looking at the price of what Chinese stocks are doing and sort of capitulating the bottom here, right? Like, so much.
I was just going to say the same thing.
Because this stock, this is the Hang Seng. I mean, it is plumbing. The lows here of the last time it looked this bad was literally 2009.
Yeah.
Like, this is the lowest has been since 2009. That's pretty crazy. Usually when something underperforms for that long, right, that's when everyone sort of capitulates and says, no, all these reasons, X, Y, Z. And it doesn't actually seem that compelling we'll link the Bloomberg article in the show notes, but, they're citing, being unsure about China's policy and sketchy economic data. It's like, well, what's been going on for the last 20 years? Was anyone ever particularly sure about that policy or thought great data was coming out of China before this? I'm sort of unsure what changed.
I think the difference is leverage. Like, their real estate crisis is like 10 to 20 times the size as ours. So, dealing with that takes years and years to work through. On top of that, what's the tectonic shift that's going to get money back in the door there? They don't even care about their equity market. All they care about is their bond market. So, like, they can talk as much as they want, but they're having a declining demographic situation there. I don't think it's particularly a great risk reward when you look at other things. Especially because, you are kind of incentivizing your enemy in a lot of senses. So I don't know. I think there's other allied systems that you could invest in that's way better. Mexico's demographics that are incredible. They're right next door to us. We could do a lot more things there, and the trade would be a lot easier. So I don't know. I'm in the stay bearish there until something changes politically, but it's really hard. These geopolitical things, I'm not exactly an expert by any means, but my main thing is I think a lot of money is coming out of there and going into Bitcoin, because that could be, they really created like an economy on steroids for 30 years based off leverage. Their banking system is so levered, where if you're a wealthy person in China, you're probably trying to find ways to get your money out of there and put it in something that's decentralized. But what China is proven good at is just keeping that money stuck in there, right? Through their safe capital controls.
That was the Bitcoin mining ban in 21. That was the easiest. You could just buy machines, make Bitcoin, and get the capital out the door. And the headline reminds me a little bit of when Goldman's had commodities research, that Jeff Curry guy stepped down. It was like the oil bottom, and they had their top commodities trader step down last year too. I don't have a view.
Yeah, if you just looked at these two charts, so we've got the S&P superimposed over the Hang Seng, and you just tried to imagine what are people saying about each one of these assets. You'd imagine the one that's going down, people would say, oh, nope, can't own this. And the one that's up 1,000%, or whatever over this timeline, people would be like, yeah, you got to buy this. I just feel like that's probably probably the way that it works. But
Can I bring up one last macro thing that's like pretty important that like no one's really paying attention to, which could shake things up. This is like a risk, but like the yen, Japan is the backbone of central banking. They first came up with QE, and they're actually talking about hawkishly raising rates, which has the yen rallying here. And that's partly the reason why the dollar's been selling off pretty hard. So, pay attention to, what happens there, because if you get a repatriation of cash where you sell US assets, you're a Japanese investor and you repatriate it, because for a while you were borrowing yen to buy international assets. And if that whole carry trade reverses, it could have some ramifications across macro in general, Bitcoin included. So that's one big risk I'm paying attention to.
I'm totally in that camp. It's not talked about anywhere. I think like it's the implications on yield, U.S. Treasury yields, which then have implications knock on everything. Japan, like they have to get out of this at some point. It's their actions for the last year and a half have shown they're trying to, like, in the most controlled way possible, and any rising of yields there has an effect globally, just given their position in the market. So I agree, Tyler. I think that's probably one or two on my list of highest risk that black swan type things this year.
Totally. And the interesting thing was what's stirring them to do this is the labor unions are basically coming out and asking for higher pay. So wages are going up there, which is like, you get that reinforcing wage cost spiral, and that would really kill a lot of what's going on there. So I think that's their incentive to the BOJ is like, okay, let's start tightening up policy here a little bit.
Let me ask you guys one more, and then I know we got to go soon. Is we just had a jobs report come in today. So payrolls grew by 275,000. That's 75K more than expected. So on the surface, that looks like a hot jobs report, but this has been the story for the last year. Is the prior 2 months were revised down by a combined 167K. So if you net those two things out, it was a miss relative to expectations. And I think where this has implications is yields and expectations around rate cuts here in the US. So earlier this week, the three of us were asking, what really is the rationale for cutting rates here? It just feels like the market is pretty heated, like labor market looking okay. I guess one thing that people probably we know that the Fed doesn't really look too much at the stock market, right? They're looking at other data points. They care a lot about PCE, and they definitely look at the labor market as well. So if they saw signs of cooling in the labor market, employment went to 3.9%. Now, I will say I saw a lot of headlines, unemployment at 2-year high. Okay, but that's still pretty low relative to what unemployment has been in the United States. It wasn't that long ago that people said 4.5 was neutral. So we're still pretty low on unemployment, but it does look like the labor market might be softening. What do you guys think about that? And I actually saw as well that the odds of a rate cut in June jumped to 80% as well. So for what it's worth, the market hasn't priced this super accurately, but it jumped a little bit from like a 63% chance to an 80% chance. So what do you guys think about this?
Yeah, I mean, Powell's testimony, I think, played in that as well, where I think the quote was something around, we're getting confident, we're becoming closer to cuts or whatever. This jobs report, it's kind of like a nothing burger to me. It's like the economy's strong. I have a hard time seeing unemployment like really, crap in the bed if we're getting like 0.5 to 1% annually, our country's population and immigration, like over the southern border. Like, I don't know how, if we're adding so many people into the, like, maybe it's not counted, but the potential workforce, and with numbers where they are, like, companies aren't laying people off. So I think it fits the narrative here for the Fed to kind of take some cover to be able to cut. But to me, I have a difficult time seeing how things are restrictive at current levels. And that just kind of boils down to the fact that the governments are spending at levels they haven't spent in decades. So it's just a different regime that I'm not sure the the last 20 years of monetary policy strategy will work as well. But that's what stocks and risk assets are thinking as well. Like, all right, they're going to give it to us here.
My take on this number is just like you had 100,000 jobs revised lower from the last report, yet like there was billions and trillions of dollars that traded off that. It's just a funny like
Yeah.
it makes no sense as to why people trade so much off a number that like can change that much, but it's just
like CPI too, where it's just like
yeah,
it's crazy.
Yeah, very funny.
You know what? One last observation on this is it is funny because there are a lot of assets right now that are nearing all-time highs. Bonds are well off their all-time highs, but they're trending up. And like stocks, US stocks, all-time highs. Gold actually quietly had a breakout into all-time highs. Crypto, all-time highs. And one observation that I would make is that everyone has a different fundamental reason for why their asset is going up. So in the gold community, it's central banks buying. In crypto, it's these ETFs, and there's going to be these sovereign wealth funds that come in. In stocks, it's the economy is actually pretty stronger, earnings, all that stuff. I don't know. It feels like the market just wants to go higher. Like it feels like just a risk on sort of sentiment here.
Check this out. This might be a little too derivative-y, but if you look at implied correlation in the market, it's actually at like record lows, which is basically saying like when implied correlation is high, the VIX every stock goes up and down together. Very high correlation means like, you can have a crash, right? And when correlation is really low, it means every other stock is kind of like behaving with its own personality, which keeps volatility generally very low. And essentially like the risk is more like the upside than the downside. And people still buy like implied correlation is down it was down like 8% today. And, the VIX is flat, but that should be a drag if it stays this way.
All right. What do you think though about, what is the commonality in between all of these assets that I just listed there? Crypto, Bitcoin, gold, and it's not the whole stock market, right? It's like the Mag 7, or it's really NVIDIA, right? It's like that meme of NVIDIA holding up the entire world. It's these like long duration sort of trades. That's what I feel like that's the correlation between all those things. And people have been pointing out for a long time the lack of breadth in the stock market. It has been the Mag 7. Recently, it's been NVIDIA. We actually talked about Tesla and Apple both selling off a little bit, which is probably the China influence. But yeah, it might be worth pointing out that there is actually a commonality in between all of those different assets that are doing particularly well. Right?
Yeah,
and I think this is
store value. They're trying to stay ahead of potential inflation and debt means nothing.
Right.
I think this is where the stocks, crypto, put your risk asset in there, can't go down in an election year narrative has truth is Yellen, Powell, and the whole gang are out of job. And if they don't keep the incumbent in office, and the easiest way to keep the incumbent in office is strong economy, strong markets, everybody more money in their pocket. So I think that's the common denominator here is because it's so good to watch the AI bulls fight the crypto people, fight the gold bugs, and then you just watch it. It's like that meme, and someone else is watching, and it's just like all the same underlying driver.
I used to be like a Fed hater, and I used to be like a policymaker hater, but like your job is to kind of keep like they really.
I agree. I agree with what I think you're going to say here.
And so what the problem is, and this is the most simple math, but if you have $100 basket of goods and inflation is at 2% and productivity is at 2%, that means that if you hold cash, you are getting taxed 4%, which is the delta between inflation and productivity for holding cash. And the Fed's job is to keep that somewhat small, that delta, because if it's large, then you get crazy stuff happening. And I think that they've generally done a pretty good job with that.
I think about this all the time as well, because it's so easy to chirp from the cheap seats, but this has been a really tough 3 years to be a policymaker. Yeah, I'm actually shocked that Powell wants to do it again, or Yellen, or any of these people. It actually blows my mind that you'd want to put yourself in that situation.
Power is a addictive drug, my friend.
Hell of a drug, I guess it is. But
I hear. How about this argument? If it's a fourth turning and like people are losing faith in so many institutions, that's actually one that I'm kind of impressed with. They've lowered the debt to GDP. Like they've played the global hegemon of like capital markets quite well. Like Yellen's managed the yield curve where like they've issued on the bills. They haven't had a long duration spike. Powell's done pretty good job bringing inflation down. Like it's actually how it's designed to work.
I know.
And I used to hate on it. That being said, it is kind of like a boomer Ponzi scheme to finance all the pensions and all this stuff. But like the release valve, millennials and Gen Zers are naturally finding it's happening the way it should. And these new first turning institutions are happening. It's like it should.
I think
it's usually time horizon differences. Like the people that are doomers are like, this is bad long term. And I think everyone kind of agrees with that.
Yeah.
But the people that are like more tech forward, like, no, this, like, why are you so bearish? And it's like, this is fantastic, which it benefits all this stuff. I think so much boils down to difference in time horizons.
Yeah. Yeah. True.
I agree. I think it's a really tough job. They had to thread the needle. I think, sometimes I oscillate internally in between being like, they actually did a pretty good job of threading this needle versus I saw this thread from Dan Moorhead, where he said, look at how much we've done at so little cost. He's like, well, the cost is the debt. And, we literally defeated fascism for less, in terms of what we did to ourselves in this country. And so it's TBD about which one of those perspectives is ultimately going to end up getting proven right. Because, at some point it's like, oh yeah, what Powell and Yellen did is pretty clever here. They did manage to thread this needle. But on the other hand, it's like, or did they actually do anything clever, or did they just borrow more money than God and paper over every problem? I'm just stuck in between those two, in between that. Like, did we really do anything clever here? I'm unsure. So
if you own Bitcoin, they're very clever. If you're sitting in like Hershey's and General Motors stock, you hate them.
Fair. Yeah.
That's very true. All right, fellas. I think we got to wind it down here. This was a really fun one. I'll see you guys next week.
See you.
Sounds good. Take care.